Right, so let's look at what's happening here. Um, we have a bank rec to deal with, so we have a a cash book that has a debit balance of 3,057 and a bank statement that has a balance of 4,924. So first thing, it says here that you have a check for 63 received from a customer. So you'd put it in here, right, that you received this money, but it was disowned by the bank, so it never quite went in the first place. So you need to de-recognize that, right? You don't have it. It's not in here. You need to get rid of it. Um, so you need to credit your cash book. In a way, think of it like this. Imagine, right, you had an expense for £63, or you were owed £63 by somebody, right? Um, let's just say that's a sorry, you're owed. So if you're owed, that's a trade receivable, right? So you're owed. You're owed. Let's just call it a trade receivable. You're owed £63. What would have happened was this: when you got that check, you would have gone credit trade receivable and debit bank or debit cash book. So you would have 63 in here, right? Debit this and credit this. When you now find out, let me just, by the way, get rid of this. Sorry. Yeah. So what started off, you'd have sold some goods on credit. Let's start from the beginning. I think that's kind of the best way to think about this to really help you get engaged with the process. You would have sold goods on credit for 63, trade receivable 63, sales 63. Then the person sends you a check to pay what they owe you, 63, and you have 63 in here, right? But what ends up happening is that the check bounces. So you realize, oh, actually, I haven't received the money. So the person still owes you 63. So you take the 63 out of here. When I say take it out of here, you kind of credit 63 here and you redebit the account. That's the double entry. That's why you have 63, forgive me, on the credit side of the cash book, because you're reinstating the debt owed to you, right? That's what you're doing. Until you find out that the person can't pay you or whatever it is, then you may write it off. But until then, you need to reestablish that. So you can see the drama here. This 63 started off with this 63. Then we got paid. That 63 is in there somewhere. Then they can't pay. And then you now finally reinstate those 63s, right? So let me just tidy this up a little. Just get rid of all of this so that because I don't need it. So what I have here is 63. 3057 is the balance here. 3057, and then you have 63. I'll just change my pen color again to red. Next one, customer has overpaid. So they've overpaid, and therefore in your bank you have two remittance advices for 670 each. You only one should come to you, and only one will be in here. You would have recorded the 670 in here, just the single one, but here you have two in your bank. So you need to get rid of one, right? In terms of reconciling, there's an error in your bank because of those two payments. Then it says here an advice has been received from the bank showing bank charges of 92. This has been entered in the cash book, but not yet in the bank statement. So the bank is yet to show the 92 coming out. Then a direct debit of 128 has been recorded in the cash book as a receipt. So a direct debit of 128 has been recorded in the cash book as a receipt. So there's 128 in here as a receipt when it should be an expense. So first of all, we need to get rid of it, if you like, out of here. But then we also need to recognize the actual expense, right? If you like. So this direct debit could have been for electricity. You see, I don't know. And what you should have had was you should have had possibly you would have had 128, depending on the kind of error actually. You'd have had 128. It's been recorded as a receipt. So who knows? Maybe you had something that looked like this. Let me just change my pen color just to give you context. So instead of putting 128, you've paid, technically you should have done this 128, 128. What you ended up doing initially, if we erase all of this, what you might have done was something yes, like that looked like this 128 128. You're like, oh, this is an error, this is wrong. So what you need to do is first of all get rid of that. So you do the 128 128, and then now you need to fix it 128 128. So now you actually know, you're now recognizing what should happen. This first one just clears out the old journal, and then the next one deals with that. Okay, then it says a back receipt of 1,500. You've received 1,500. It's showing in the bank very nicely, but not yet in the cash book. So let's, if you like, recognize that in the cash book. And then it says here, faster payment to a supplier has been delayed by the bank due to a change in the recipient's account number. It's not showing. So we've recorded it quite okay, but it's delayed here. So we now put that here so that it aligns with what we're doing. Right. So, by the way, first of all, this was just me explaining, right, what's happened. That 128 is actually in there, right? So these are the only transactions that are important. So what we now have, this question asks you, what are the three transactions? They want three, so I suspect they put these two together to make 256. So, I mean, you could do them as a double, but really they should be individual, but anyway. And so these are the three transactions that will affect the cash book. That's what this question is asking. If you like, yes, over here, this question is asking. So you have 63 as a credit, well, 63 as a credit, 256 as a credit, and 1,500 as a debit. All right, and that's what you have over there. Right. So that's that. Then you have this one. Let's just see. And what they're really asking you here is to look at these organizational policies and procedures. Why is it important? And I'm sure you looked at all of these and you probably did go help enable both individual and team responsible to be understood. Okay, great stuff. Now, here what we're doing is we're just really playing around working through the adjustments with the extended trial balance and looking for those things that affect the income statement and the balance sheet, right? So here we have allowances for doubtful debts. This is a liability. No, this is a balance sheet account here. We will see whether or not there are any adjustments for it in a second. That's your bank account, and you know that's going to end up here. So you started off with this, but then you have this coming off it. So you have a debit of this minus this. So whatever your answer is, it's going to be in there, isn't it? Right. So you're going to have, oops, sorry. You're going to have 5726 minus 2416. So you're going to have 3310 here. Yes, because that's your that's the difference. That's your debit. So just think of this as a T account. Just think of all of these as T accounts. That's the debit side. That's come through and affected the credit. So the carried down figure or the brought down figure is going to be 3310. Capital, you must have put some more money coming in because you start off with that, then you add that onto it. So you now have 19070 plus 9430, 28,500. It's a credit, of course, 28,500. Those are the ones I can see straight away. Closing inventory is closing inventory, right? So because it's used as the it takes off. It works. We use it in cost of sales, but we also use it in the in the balance sheet, right? So that's just going to come here as an asset of 17510, right? That's what's going to happen. So because this is really a journal, so debit, closing inventory, credit, cost of sales. That's why you're seeing both of them happen here. So depreciation charges, that's a profit and loss move 5946, right? That's also actually, so that was a depreciation charge happening there. in the period. 1 second, and then we have irrecoverable debts, so of 490 happening there. Office expenses, these are all adjustments. So you know, we're just increasing this. So typically, you know, like if you're accruing or prepaying, that will all happen here. So you have these office expenses, and we're putting through the adjustments. Yes, so office expenses coming through 1333 plus 1320. So a complete adjustment. This is most likely to be an accrual, isn't it? Because you're increasing the office expenses. So 34,542. No problem at all. And then you have your opening inventory. I mean, so suppose your closing inventory is 17,510, and you have your opening inventory here of 16,760. Yes. Other payables. So you had a credit, and you have a further adjustment, and of course that goes in there as 1460 plus 1320, and it's 2780. Yeah. Payroll costs, no adjustments to them. 28,381. Right. Purchases, no, there you are. 1,777,363. Purchase ledger account. So you have that. You have a further adjustment, and that's of course a balance sheet adjustment. So you're going to have 19,402 plus 495, 19897, 19897. So this is critical. You need to be able to do this because you can see there's a lot of marks here, 11 marks, and you don't want to not get this. So those are your sales. Sales are happening here, 26,807. 26,807. Sales ledger control account, that is an asset account. 38934. Suspense account should close out because you can see here you had 5. You have this adjustment here, that, and there should be nothing through. We typically don't carry suspense accounts through, of course, anyway, but all this should cancel out. The VAT will have a net. You have the starting figure, then you have this adjustment, which means that you have still have a net liability of, because this is a liability account, or it could be an asset account or liability depending on what's going on, but it's in the balance sheet, isn't it? The VAT liability based on all the sales. So it's 5,225 minus 5,225 minus 2,416, 5,225 minus 2,416. So it's 2,809. Then your vehicles, you have a debit here, so you must be buying some new vehicles because you're starting. You have your trial balance is ending 2280, but then you have some adjustments of 9,430, 31710, 31710. And here's your accumulated depreciation sitting next to it, 13,873. And here, well, nothing happened. I actually thought something might there. I thought there might be an adjustment, maybe somewhere down the line. There's nothing in here, therefore. So therefore, this allowance carries through. Yes, it comes off. It's prudence, isn't it? It's going forward and to make a provision, or we think or believe that we will lose 1,500 in the future. So we have that, and that this balance sits under your sales ledger control account in your trial balance. Oh, sorry, 1 second. I just need to answer the door. So let's just finish this off. So we've done all this, put all this through, and then we're here, aren't we? And so really we just need to finish off. And so we have profit or loss for the year. And that's the difference between, of course, the income statement, which will, of course, apply naturally there. So you can see here that your difference, you have a debit, an expense side, so to speak, and a credit side or an income side. And therefore you have a profit, if you like, to balance this off, which would be 285,517 minus 263,482 is 22,035. 22,035. Yes, and that should balance that off. And that should be exactly the same thing here. 22,035. And that should balance that off. No, I haven't balanced. Right. Okay. So what have I missed? 22,285,517. I'm out by £300. So let's just see where I've made an error. I must have a numerical error somewhere. 38,934, 268,007. This is 268,077. Sorry. That's what that is. Sorry, that's not that anymore. Sorry, sometimes you are rushing. 177,363, 28,381, 38. Okay, let me get rid of this as well. 13,873. Let's see. I have a numerical error somewhere. Okay, just because of time, let me go to the answers and see where my it's a calculation thing. Where let's go and see what we're looking at here. So we have all the entries in. Wonder what I've missed out on. Let's just look here. I'm sorry. No, let's just come here because again, it's an exam, so and it's good. You see, it's good you do this sort of things. So it's okay if you make you're getting marks for all the entries anyway. 22, 105, 91, 285, 587. Let's see if I have the same thing. 285, 285, 587. Let's just try that again. 285, 587 minus 263, 482, 22, 105, 22, 105. Yeah, would that work here? 22, 105. Oh, yeah, so that would have worked. Okay, great. So we're balanced, right? And that's the end of that task. So the key aim is to think of it like this. At the end of the year, this is what your accounts are saying. So there are adjustments that need to come through. So you need to put through these final adjustments, or these could have been these are just a trial balance that's come through, but we need some further adjustments. Oh, these could be adjustments during the year. It actually doesn't matter. You're just adjusting along as you're going to affect each balance, and you're deciding whether each balance stays in the income statement, whether it's an income statement event so we can get profit. So it's almost like the accounting equation. Think of these as your I minus E's, right? This closing inventory is the journal debit cost of sales, sorry, debit closing inventory, credit cost of sales. That's why this is a credit in the income statement section, just in case that's playing on your mind a little. And it's a debit, the asset of closing inventory under current assets, isn't it? Because yeah, we can only, sales is revenue minus cost of sales. So we need to reduce the opening inventory, which we have here, plus the purchases, which we have here, by the closing inventory. That's what you have here, right? So we're just putting those through. This happened during the year, so that's an adjustment. That's a depreciation charge coming through. Yeah, and that's that. Cool, great stuff. I hope that's been helpful.